health crisis. It is affecting societies and economies at their core. With economic activities being shut down, there is a tremendous confidence effect. Looking back into history, crises have always been the norm rather than the exceptions. Starting from the tulip mania in 1630, economic and financial vulnerabilities have generated waves of crisis in the world economy. Not all the crises by nature have been the same. Rather, they came in and had different origins. Some of these remained confined to the domestic or regional boundaries, and most of them spread in no time from the peripheries to the center, with an ultimate devastating impact on the entire economy. In today's knowledge-driven, financially integrated era, such speedy spread of crisis is almost inevitable. The financial crisis of early days, for example, those in France and Britain during the latter half of the 1710s, remained confined to the regional territory. The first significant global crisis has probably been the Panic of 1825 that initiated in Britain and eventually spread to the markets of Europe and Latin America. Since then, the global economy collapsed many a times. Panic spread from the US to the countries of Europe, Asia, and Africa in 1857. Apart from some regional crises in 1819, 1837, 66, and 1893, global economy witnessed catastrophic crashes in 1873, 1907, and most importantly in 1929. During the 1980s and the internet bubble during the last few years of the 20th century were followed by a global financial meltdown that was on track since mid-2007. This crisis was being described as the worst financial crisis since the one related to the Great Depression of the 1930s before the outbreak of this recent pandemic. The analysts are once again visualizing a financial crisis to follow. Now, before we go into that, let us first of all consider what generates a financial crisis. Financial crises are often seen as black swan, so events that are fatal but improbable and extremely difficult, if not impossible, to predict. There is then no single path that financial crisis could follow. Treating financial crisis as black swan ignores the fact that although the crisis-bearing mechanism differs from one crash to another, they have much in common. Almost all crises are crises of confidence that begin when an initial boom turns into a bubble. But what makes a boom take on the path of a bubble? Now, we must admit that a silver line does have its clouds, and each boom brings into its train a potential bubble. Usually, a typical bubble begins with a precipitating factor, such as development of a new product, a process, or a theory that seems unique to the investor. This is usually followed by an amplification mechanism, generally in the form of assertions from media and live institutions that reinforce the view, and the resulting stock price hike that convinces the investors about the emerging opportunities. People seem to keep faith on the four most dangerous words in finance. This time, it's different. Investors start believing that the traditional rules no longer apply, the current price rise is different from bubble, the market is flawless, and most importantly, the boom will continue even in the presence of irrational exuberance. The initial increase generates expectations of further increase and attracts new buyers, normally speculators or the momentum investors. The rule of the game now becomes momentum, staying close to the herd and tracking everyone else. Now, the rational investors who realize that not all of it is legal and not all of it is wealth are crowded out, or they found it difficult to bet against the bubble to stop it in its track. The bubble bursts when the initial euphoria turns into a retreat. Now, if we consider the recent scenario, then we find that the stock markets all over the world has witnessed some interesting movement. The stock market indexes declined for over a month starting from mid-March to mid-April. The portfolio investment, typically, which is a volatile asset class, have reacted rapidly to the shock that the pandemic inflicted on the global economy. The economies that had entered the crisis with weaker positions have already experienced massive outflows of portfolio investment. Now, this repeats a familiar pattern whereby international investors transfer capital back home or invest in safer assets during periods of uncertainty. Now, what appears exceptional about the capital flow dynamics during this pandemic period are the scale and the speed of the outflows. Now, if we consider the different regions of the world, here we have the US region, the European region, the Asia-Pacific region, and along with we have the Indian market. So here we are showing that there are two crisis periods. The first one relates to the global financial meltdown of 2007-8, and the second one is related to the current pandemic situation. Now, the point is, during the financial crisis of 2007-8, as I was mentioning earlier, there was a fall, but if we consider the recent phase, then the sharp has been declined in almost in all the markets. But the point is that there has been some recovery, and this recovery is continuing since the mid-April. Now, the point is, what drives this run? Trouble spot that is going on unnoticed, or it is just left unattended in intense speculative interest? Is it a bubble that is going to be pricked? Is it a side effect of the monetary policy that is currently undertaken? Or is it the real economic value creation that has started? In that case, it should be backed by fundamentals. Now, is it so really? If we consider the fundamentals, then we find that the current global economic crisis is unlike anything the world has seen before, with a higher degree of uncertainty about the recovery. For the first time since the Great Depression, both the advanced and the emerging market economies will be in recession in 2020. And as per the IMF report, the countries are looking for the emergency financing. IMF forecast says that the global GDP is to contract by 4.9% this year, so it has been revised. Earlier, we were thinking that the projected GDP will be shrinking by only 3%. The inflation is anticipated to rise, and unemployment in some sectors are definitely going to rise. The trade could fall by 12% to 32% this year. Consumption has been reduced across the globe. Moreover, there has been growing number of export prohibitions and restrictions. 80 countries and separate custom territories have introduced export prohibitions or restrictions as a result of the COVID-19 pandemic. Transparency at the multilateral level is lacking. Of course, e-commerce is flourishing, but we have to bridge the digital divide both within and across the countries. Trade in services that involves proximity between suppliers and consumers has been severely impeded. Moreover, a lack of resources to support an economic rebound is compounded by the LDC's dependence on a limited range of products exported to a few markets, some of which have been those worst affected by the COVID-19 outbreak. The pandemic threatens to derail the hard-won development gains in the LDCs. Moreover, as the migrant workers from the LDCs return from the host countries affected by the pandemic, flows of remittances have dramatically dried. If we consider the FDI, then FDI could play an important role in supporting economies during the economic recovery. Now, evidence from the past crisis has shown that the foreign-owned affiliates can show greater resilience during crisis because of their linkages with and access to the financial resources of their parent companies. Now, FDI would be particularly important for emerging and the developing economies, given that other sources of international financing, including portfolio investment, have fled these economies. Unfortunately, it appears that the impacts of the pandemic on FDI flows to these economies may be particularly severe. Now, all these have led to the weakening of the currencies of the emerging markets and the developing economies. But the short-term gains from weaker currencies may be limited, especially for these emerging markets, because the firms price their international sales and finance themselves in a few foreign currencies, notably the US dollar. Moreover, there are other risks like inferior asset valuation, volatile commodity prices, and political instability, and so on. Corporates are being hard hit too. First of all, their earning projections and price and profit projections have been downward revised. Their credit rating is low. The bonds are supported by poor protective covenant. And as the MNC profits fall, the reinvestment of earning would also fall. And there has been substantial fall in the cross-border merger and acquisition and in the new project announcement. So this might have adverse impact on equity flows. Moreover, there are challenges to the current monetary policy in this low interest rate environment. The conventional policy space is being exhausted. Further, what is more important for our analysis is that there may be some unintended consequences, such as the asset markets, the financial markets, may become completely detached from the economic fundamentals. So that is definitely a danger sign. Now, IMF has already praised the central banks for providing stimulus to help the financial markets to gear up, so that the financial markets might develop, but it will be there as long as the support is ongoing. So if there is no such support, then of course the problem is going to be a really grave one. So the current run is not supported by the fundamentals. So in this unstable phase, is there any asset on which the risk-averse investors, and we are all risk-averse, if we were risk-lovers, then all these questions and analysis would not arise. So is there any asset on which the risk-averse investors can depend to hedge against the risk? Now this is particularly where the green investment comes in. The issue of green investment is receiving considerable attention in recent time. This is particularly because that we are at a global level, the discussion is following a specific path. So they are saying that emerging from the crisis, we must emphasize on building up a world that is more resilient, more efficient, more inclusive, and more sustainable. And according to them, this can be done by focusing our efforts on tackling climate change, and eventually we need to go for green investment and to accelerate them. Now, although it is so important, it is equally difficult to ensure that the corporates, who are among the significant polluters, would be going for the green investment. A profit-maximizing corporate would be attracted to green investment if and only if it can earn substantial profit. In terms of financial performance, this requires higher valuation of stocks of green companies. Now, increased demand for stocks, however, might come from risk-averse investors, if and only if the stock is less risky. We shall be talking about the speculators later on, whose demand would destabilize the situation further. Literature finds enough support that the green investment outperform its non-green or grey counterparts in the stock markets. At this point of juncture, we shall show that the green stocks are inherently safe, so that investors might use it as a hedging instrument in these turbulent phases. While investors keep faith on green stocks, their valuation increases, making corporates interested in going green. Thus, while green investment is essential for a better future, its intrinsic safe nature makes it a safe place for investment, which in turn makes the process for going green smoother. Now, we shall show how is this possible. Now, while talking about the risk of investment, we shall be talking about the unique risk and the market risk. So, unique risk is associated with the riskiness of the asset itself, and the market risk is more painful because it cannot be diversified. So, it shows the sensitivity of an asset return to the market return. The sensitivity of asset return or such market risk is estimated using this particular model, which is actually a very important model in financial literature. This is the capital asset pricing model. Now it says that, so our RI is the return from the ith asset, RF is the return from the risk-free asset. So RI minus RF is the risk premium that we are getting on the ith asset. Similarly, RM is our market return. So RM minus RF gives us the market risk premium. So beta shows how sensitive this particular asset I is to the market movement. So if beta is equal to 0, the asset is not related, the asset's return movement rather is not related to the market movement. But if beta is greater than 1, then what happens? If the market rises by 1%, the asset will rise by more than 1%. So far, so good if the economy is doing good. But if the problem is the market falls by 1%, the asset will be falling by more than 1%. It is inherently risky. So beta greater than 1 are the aggressive and they are inherently risky. Alternatively, if beta is less than 1, then it falls by 1%, then the asset will be falling by less than 1%. So the asset, and it is, of course, less risky. Now, we have considered a period from 2007 to 2020 July. So this period will be considering two important crises, the financial meltdown of 2010 pandemic situation. So we have considered 4 regions: India, Europe, US, and the Asia Pacific. So their indexes available. So before we move further, what is a green company or what is a green stock? Now, green stocks or green companies are selected on the basis of 3 things. Number 1, their turnover, the sales. Number 2, their size in the stock market, how big they are in the stock market. It is measured by market capitalization, and their carbon emission. So these are the 3 things. On the basis of that, we pick up the most efficient, most carbon efficient stocks, and we then construct the green indexes. So for India, we have the GreenX as the green index. It was launched in 2008. So India is relatively a newcomer in the field. So along with that, we select the BSE Sensex, the 30 stock index as the Indian benchmark or the market index. We have 3 regional green indexes. Dow Jones offers the sustainability indexes. So that is why these are called DJSI, Dow Jones Sustainability Indexes, for the entire European region, for the entire US region, and for the entire Asia Pacific region. So Asia Pacific region excludes India. So we shall be talking about India separately, and of course we shall be having some interest in Indian market also. And then we have the 3 market indexes: Stocks Europe 600 for Europe, DJIA, this is the Dow Jones Industrial Average for US, and the Stocks Asia Pacific 600. So here we are considering the movement in the prices of the US market. So these are just the index values and the green assets in the 4 regions. So in some cases, the prices are more than the market and in some cases the prices are less than the market. But the point is, just by looking at the prices, it is very difficult to come to any conclusion, because as investors we are more interested in returns, not the prices. So that is why any conclusion should be based on the returns and not the prices. So that is why we move towards the return, and return is nothing but, in the simplest form, it is nothing but the proportional change in the prices. So we have considered the return series, and now we are considering the cycle. Now, if we plot the actual return series, then we just seeing it as some fluctuations, some random fluctuations around the horizontal axis. So that will be giving us no insight. So that is why it is better to talk about the cycles. So we have considered cycles in the 4 regions. Now, if we consider the US market, then initially when the market was in crisis in 2007-8, the green index was moving in line with the market index, right? But the interesting point is that during the recent year, when the market is the cycle is actually going down, then the green index is giving us more. More interesting is the European green. Now, if we consider this, there is a very significant result. So in this phase also, like the US market, in this phase, so these are the more matured, more advanced markets. So the movements are more or less similar, right? So green index was more similar to the markets. Now, after that, there is a significant difference. Now, say when the market is rising, green returns are falling. Now, that is not problematic, because we are all risk-averse investors. So we shall be focusing on these parts. When the markets are falling, the green returns are substantially higher. So that is more useful for us. And the same thing is happening here when the market was in crisis. Now, a problematic part perhaps may be seen here, where the green cycle is just lower than the market, but maybe after some point of time, it may give us a higher return. But over time, it has given us a higher return during the crisis. Now come to the Asia Pacific Green Index. So the result is something different. During the 2007-8 crisis, greens were giving us more. In the recent crisis, now see, it is just the opposite of the European market here. And in this case also, see, when the market is rising, green index is giving us more. But since it is not that advanced market, so when it is falling, its fall is more than the market. But the point is, if you consider this small stretch, then the green indexes are giving us better return. Now come to the Indian market. Right. So when during the 2007-8 crisis, when the market was rising, of course the green investment was green returns were less than this. But when the market was falling, the greens were giving us more, and the same relationship is being shown here. So if we consider the cycles in the returns, then of course we get some idea about the resilience of the green investment. Now we come to the, as I have pointed out earlier, I have made that beta, the market sensitivity, dynamic over time. So these graphs show how the market sensitivity changes over time. Now these graphs are very difficult to read, so that is why I shall be going to some other graphs. So these are the empirical survival graph. So what does this graph give you? This graph shows the probability of getting a value which is at least as great as a given value. So let's take an example. So consider this diagram. On the horizontal axis, we have the values of beta. And on the vertical axis, we have the probabilities. So for the value beta is equal to 1, the probability value is slightly above 0.4. So we may take it as 0.4. So what does that imply? That means that probability of getting time varying beta or market sensitivity, which is greater than or equal to 1, is only 40%. Right. So that means the US green stocks are essentially defensive. Only in 40% cases you will be having the stock to be an aggressive one. So of course they are less risky. If we come to the European market, then the situation is even more better. The probability of getting an aggressive green is even less than 40%. Come to India, less than 40%. Come to the Asia Pacific green. Probability of getting an aggressive green is roughly 10%. So what does that basically mean? This means that the green investment are really the safe places for investment, just because of the fact that we are concentrating on the market risk, which we cannot diversify. So this market risk is actually quite low for the green investment. Consider the cycle in the time varying betas. So we shall be showing these three markets on one hand and Indian market separately. This is because, as I have mentioned earlier, the Indian market has been a relatively late entrant in the market. So these are the more advanced and more matured market, but we have the Asia Pacific market in that also, and that Asia Pacific market, because of its developing nature, will be having its own troubles. Now, if we consider the cycle, then what happens? This is how the market sensitivity moves over time, or risk moves over time. Now, so there are clearly two humps. One around the 2007-8 crisis and one around the recent pandemic. Now, here, the green line shows the Asia Pacific TVB, the red line shows the US, and the blue line shows the European. So, as is revealed here, the Asia Pacific greens are relatively more riskier compared to the others. Market risk is relatively higher. Okay. Now, so here, when the market was moving towards the crisis, so it was not in crisis, it was just moving towards the peak. So this was the period. Then the market risk of green stock was increasing, right? But the interesting thing is that when the market was really in crisis, in this case, the market risks fell significantly. So that was for the 2007-8 crisis. So when the market was in crisis, the market risk of the green stock was reducing. Now, come to the recent pandemic situation, the same thing happens, exactly the same thing happens. So when the market was moving towards the crisis, no doubt the market risk was increasing. But the interesting or the beauty of green investment is that when the economy is really in crisis, the market risk of green stocks fall. So they are the safe places for investment. And what is more important is that this nature is there irrespective of the levels of crisis or irrespective of the type of crisis. So it was like that in 2007 crisis, and it is like that in the pandemic situation. So of course, the investors will be finding it as a safe place for investment. But what happens to India? Let's go to that. So that is the Indian cycle. Cycle of the risk. Now, as I have mentioned earlier, that India was a late entrant, and perhaps that is reflected in the risk. So when the Indian greens was first entering the market, then perhaps it was not that matured to avoid the problems of the market. So that is why during the 2008-9 crisis, the market risk was increasing. Now this was the period of crisis, because if you could recall, the Indian market, the crisis in Indian market was initiated in January 2008, and it continued till 9th or 8th or 9th March 2009. So this was the period of crisis. So during the 2007-8 crisis, This was increasing. Now, if we come to the recent pandemic situation, now the greens are quite mature in the Indian market. So now the same result is repeated here. So during this pandemic situation, the market risk of the green stocks are really decreasing. So that is how we can always take the green indexes as a safe place for investment. Now, there are certain problems, of course. The point is, as we were mentioning earlier, there may be some speculators. So the greens are, of course, very good place for investment. So the risk-averse investors will be attracted to that. But the problem is that we have also mentioned that because who creates a bubble? It's a speculator. So now our point may be whether the green indexes will be attracting or the green stocks will be attracting the speculators in the field. So for that, we have done a very simple study. We have considered a modification of the capital asset pricing model. Exactly similar to the original model that we considered earlier, except for this alpha term. This alpha was introduced by Jensen. And that is why this alpha is called the Jensen's alpha. So what's the significance of this alpha? If this alpha is significant, statistically significant, and it is positive, then it means that at any point in time, this particular asset will be giving us more than what the market could ensure because this plus something positive. So in that case, the asset will be beating the market. And if alpha is significantly negative, it is underperforming. And if alpha is not significant, then we are actually back to our original capital, and we say that the asset cannot beat the market. Okay. Now, why is this Jensen's alpha so important? It is important because when the significant and if the significantly positive and the asset could beat the market, it will be attracting the speculators in the field. So now we have tried to find out whether this Jensen's alpha is significant or not for the green stocks. So we have considered three separate periods: the entire period, the financial meltdown of 2007-8, and the recent pandemic. This period is actually a shorter period, but we have daily data, so observation is large, but the point is this period is too small. So probably if time goes on, we can have more data and we can have a detailed analysis also. Okay. But the point is that the Jensen's alpha, this is insignificant for all the four regions. So probably as the situation goes right now, there is no such problem of speculation. But there is still a problem. There is still a problem. It may be the fact that the current emphasis on green investment at the national and the global level might identify the sector as the sector of the future. Now, this is very dangerous, as we have mentioned earlier. This might generate optimism among the investors. Given the low risk of the stocks and the assertion about its potential, the initial euphoria might lead to an irrational exuberance. Consequently, the stocks may be excessively overwhelmed to invite speculators or momentum traders. So right now, there may not be any speculation, but as we have discussed in our earlier slides where we talked about the causes of financial crisis, then we found that any bubble can develop with such assertions. So a bubble may be developed and the bubble would eventually burst and the existing exuberance would transform itself into profound pessimism to dominate the investor sentiment. Such pessimism may be too dominant to overlook all rounded benefits and could trigger hard behavior in terms of investment withdrawal. Now, in the stock market, now as I have also mentioned earlier, that the stock market is not backed by the fundamentals. So even if we have some profound benefits, whenever we find that some other people are going to sell off their stocks, we shall always be following the herd. We shall be never considering the underlying benefits. So that is what is meant by the herd behavior. So discouraged by such withdrawal and the resultant downsizing in the valuation of their asset, corporates may be tempted not to adopt greener production process and even to elude if the environmental laws force them to do so. So that the problem will be twofold. First of all, the market will be attracting speculators and the market will be really destabilizing. It will be having its problem and bubbles will be pricked ultimately, leading to further panic and crashes. And secondly, what is most important for our global economy, that is, we must go for a green investment, particularly when the economy is going to emerge out of this crisis. That objective will be threatened. So ultimately, this will defeat the global objective of limiting the carbon footprints and pose a serious threat to the global climate. So the news will be having some news and assertions will be having some impact, of course. So we shall have to take those things into consideration. But after all, if we consider the current scenario and if we compare it with the earlier crisis period, then of course, green is one of the most safe places for investment for the risk-aware investors. So with this, I have come to the conclusion of my talk, and I'll be happy to invite questions. Thank you.
I think first we will invite questions from the students. So if the students, any student has a question, please satisfy your curiosity.
A lot of them have some knowledge about the financial economics, at least at the postgraduate level.
Yeah, I think even the third year, UG third year. Okay, is there any questions?
Any question or any clarification? Any points to mention?
Okay, then I'll ask. Okay, Riddhi is asking.
Yeah, so there is a question that I can read that. How to read the question? Okay, so okay. Ma'am, in this case, will the stock market even in future not be affected by the fundamentals? Now, this is a difficult question to answer because if you consider the literature on macroeconomics as well as on the financial market, then you will find that there has to be some interdependence between the real sector and the financial sector. So if that linkage is weak, then there might be some problem of overvaluation, problem of creation of bubble, and ultimately the bubble will be tripped and there will be panic or the crashes. Now the point is, we just cannot ensure that, or rather we cannot demand that since today the prices are not being driven by the fundamentals, in future also the prices will not be driven by the fundamentals. It may be, it may not be. But unfortunately, the stock market is seldom guided by the fundamentals. There are so many other factors, for example, the economic, for example, the social, political factors, rumors, even the sunshine, sunny day will be having its impact on the stock market. So we invest more during the festival seasons and of course during the sunny days. So prices will not be driven by the fundamentals because that is the, as the history suggests, that is the earlier trend in the stock market. So the point is the prices will be deviating from the fundamentals, probably bubbles will be developing, and then it will be crashing for some periods of time. Prices will be determined by the fundamentals, and of course there will be some perceptions and expectations. deviating the prices from the fundamentals.
Okay, Rashi is asking.
Okay, so ma'am, could you please explain? This is the question from Rashi. Ma'am, could you please explain how can we identify green stocks? Okay, so green stocks are stocks of the companies that are green. So what is meant by green? As I have mentioned earlier, there are three indicators or three parameters in terms of which the greens are defined or described. So what are these three parameters? Now, since Rashi has made this question, so there are three parameters. One is the size of the stock in the market. So it is given by the market capitalization, and then the share, the sales, which is given by the turnover of the stock, and lastly the carbon emission. So we rank all the companies and effectively their stocks in terms of all these three indicators, and then we just rank and select the first few stocks. So the green stocks will be actually the stock of the green companies. Now, how do you define green? That's the answer. So there are three different parameters.
Okay, any other question? You can please type in the chat box.
Any other question?
Yeah, you can also type in the chat box. Or does the faculty have any questions? Or do they need any clarification? Okay, then I'll ask just two questions and then I'll close the session. One is that when you're comparing with the non-green stocks, you're clubbing together all the different types of stocks, right?
Comparing with the non-green stocks. Actually, that comparison is not made here. That's a separate literature. Actually, the grey stocks, there are green stocks which come under the green indexes. And there are certain stocks that are not green. They are the grey stocks. So in the Indian context, we define grey stocks as those stocks that have, first of all, very little average turnover, very little market capitalization, and very high carbon emission. Now, what does it mean by very little market capitalization? Now, in India, there are different stocks are identified in terms of their, or they are classified in terms of their market capitalization or the sizes. So there are accordingly different indexes. So one such index is called BSE 200. So in BSE 200, we have the first 200 high market capitalization stocks. Now, for a stock to be a green stock, it must be a member of BSE 100. So the first 100 valuable stocks. So whenever we are talking about the grey stocks, then we can consider the all other stocks that will be in the BSE 200 but not in BSE 100. But once again, this is very difficult to identify because all these constituents of the index will be keeping on changing over time. So if a particular firm is not green today, it may significantly reduce its carbon emission through its different policies so that it may ultimately come into the greens. So that is how the greys are identified or are separated. So in the literature, what is happening is that for the grey indexes, for the grey stocks, there is no such index thing. So for that, either one will have to construct the indexes for the grey stocks, or they will have to take the green stocks and grey stocks separately. So that is how the literature treats the problem.
Okay, so the penny stocks do not comprise the grey stocks.
Which stocks?
The penny stocks?
Penny stocks. No, they are not green stocks.
No.
Their
not
prices.
the gray stocks, I'm saying.
Separate stocks.
Maybe they are separately treated. Penny stocks are not actually coming under this consideration.
Okay, thank you very much. And
Okay,
does
I
anyone
think there is another. I think there is another
Alia, go
question. Are you, Josh? Is there
any
any way to prevent future overvaluation that might harm green stocks, as you mentioned? Unfortunately, no, because as I have shown you, that the market in itself has nothing to attract the speculators. And the literature also suggests that there is a huge literature on that. It suggests that speculation is not possible with the green stocks, with the prices. But the point is that since, particularly in these periods of pandemic, the green investment and the green sector is being identified as the sector of the future, that might create some euphoria about the stock. So I can give you some example from the past history. For example, when the IT revolution was in full swing, then the IT stocks were excessively highly valued. In August 2000, if I could recall it properly, in August 2000, Infosys was being sold at a price of 18,000 per stock. Now, the point is, why was Infosys so highly priced? First of all, it was a new economy stock, it was an IT stock, and of course, it was backed by its sound fundamentals. But at the same time, Polaris, RAM Informatics, these companies are nowhere now. So they were selling at prices 2,000, 2,500, which is quite high in terms of, if you compare those with the prices of the other stocks. Now, the problem is, why were those stocks selling at a higher price? Because there was a higher, or rather some increased optimism in the market, so that everybody was trying to rush for the IT stocks. So the price was excessively higher. The prices may be high. I am not denying that the IT stocks or right now the green stocks, they do not have the potential to sell at a high price. But the problem is that, as it was the case with the IT stocks, the prices were much higher than what it could be justified by the underlying fundamentals. So that was the problem. So if such assertion is there, if it is identified as a sector of the future, so ultimately that will create some optimism. So eventually that will bring the momentum investors or the speculators in the field. So unfortunately, if such assertions, if such strong assertions are there, then it is very difficult to prevent a bubble to take place.
Okay, I think Rashi had a question, followed by
Ruchika. Rashi has a?
Yeah, this is Rashi.
Yes, Rashi. RI is the BSc Green X and RM is the BSc Sensex for CAPM here. So I have given the individual green indexes and the market indexes for the different regions. So for India, these two are the bases. From the analysis, less than 40% of the time, the most economies were okay. Now, it is saying that when we are making the market risk dynamic over time, so if it is moving over time, then it is mostly defensive. So there are cases when it will be greater than 1. There are cases, but those are only the 40% cases where it will be greater than 1. Right? So value of TVB was high during the crisis periods only. No. No, value of the TVP was not high during the crisis periods only. What we tried to show here is that, as it is given by the cycles, when the economy was moving towards the peak, that is not the crisis. So when the economy was moving towards the peak, then the market risk was rising. Right. So the point is, market risk was rising means what? When the market was rising, then the stock was rising more than proportionately. So in one sense, it is good, right? So when it is falling, the market risk is falling. So when it is in crisis, then the risk is lower. Okay. So it is, on an average, it is defensive stock, and it has a special characteristic. If you consider the movement in it, then you will find that during the crisis, the risk is falling. So that makes it a safe place for investment.
Okay. I'm sure all of you enjoyed the lecture, and students' participation was also quite good. But I think it's time to draw an end. And please remember that we have another lecture at 5 p.m. on 6th August by Dr. Anindya Sundar Chakrabarti of IIM Ahmedabad. So I think most of you have already registered, but please spread the word, and we'll try to accommodate as much of you as possible. And we'll again try for live streaming. If it fails, we'll share the recording with you. In fact, the recording of this lecture will be posted to the YouTube account shortly. So I'll end by thanking Dr. Gagari Chakrabarti for giving us an excellent lecture on green stocks. It's very appropriate at this time when the market is down and seems to be heading to another crisis. And with this, I end today's lecture. Thank you, all of you. Hope to see you again on 6th of August. ও অনেক আগে করেছে।
ওপরে দুর্জয়টা মুছে গেছে। বিকাশ ফোন করেছে, বুঝতে পেরেছো? বিকাশ বলছে ওই লেকচারটা আমি ন্যাশনাল করতে পারছি না, ওর টপিক দরকার।